conversation with Horizon Investments today, April 14th, 2021. We will be joined by Austin Fitch. Unfortunately, our good friend Josh Bartholomew is a little bit under the weather for good reasons, but for HIPAA reasons, I won't explain why, but Josh won't join us today. But we do have Austin with us. He's a CFA, a certified financial analyst. I believe I have that correct in its full vocabulary. And then also he's been with Horizon for 10 years, and he's now the head of portfolio strategy group. So Austin Fitch joining us as part of Horizon. We've had some great conversations with him in the past. We're going to do so again today. Mentioned in the email that announced this conversation, we would speak about taxes, stimulus, and an overall market discussion. We are going to add a couple of interesting, I believe, follow-ups to it, which a follow-up on the auto industry that we had on our last conversation, along with talking about the initial public offering swell that has come out since 2020. I'd mentioned that in my last 2-minute video, and I would like to spend a little more time speaking to Austin about that as well. So plenty to cover. I do have a disclosure that Austin will hopefully flip the page. There you go, that I've got to read. So let me get to that. Our conversation today was created in April of 2021 and is provided by Horizon Investments and Tranquilli Financial Advisor for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisor reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. This is no guarantee that their assessment of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals, risk comfort level, and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk assist is not a guarantee against loss or declines in the value of a portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when risk assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy. And accordingly, during periods of strong market growth, the account may underperform accounts that do not have the risk assist feature. While risk assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that risk assist will always limit drawdown as designed. Accounts with risk assist are not fully protected against all losses. Thank you, Austin, for that outstanding disclosure. So let's get to it. We've got a great crowd with us as always, and more that will join us later on when I send out the link. This is being recorded. The link should be sent out within a week. And Austin, before we jump in, I do want to just mention to everyone that's here that April, we've declared it Health Month at Tranquilli Financial Advisor. You should be receiving American Lifestyle magazine shortly. You'll see why we've declared it Health Month. And we do have a couple of pre-recorded webinars that'll be sent out to clients as well. One with a great chef, Jennifer Iserloh, another with my personal trainer, Dan Beater, that I'll send out. And we have a third that'll revisit a conversation with a psychiatrist about dealing with COVID and coming out of that. So I hope everyone will take a listen to those. We'll call them the lifestyle part of Tranquilli Financial Advisor. So with all of that covered, Austin, welcome back. Thank you again for joining us. The party will be muted slightly because Josh is not here, but I think we can carry the torch this week.
I think we can, and we really appreciate the time and appreciate the partnership as always. Looking forward to diving in on many of the things that you talked about.
Well, let's do it. And let's start with the tax discussion, because that really, that gets into politics, which we've always promised those that are watching live or are listening later, that we are not political left, right. We want to be financially political, if you will. So taxes have been a big discussion of course, because we had the $1.9 trillion stimulus package that was enacted, approved, and we were coming off at the end of the Trump administration that I want to say was $900 billion stimulus package that was also approved. So a lot of money flooding into the stock market, out into the hands of people that need it, and we appreciate that. There is a price to pay. It sounds like taxes will be that price. Thoughts? First off, on the possibility of an increase of taxes in 2021 and what it means from and to the market.
Yeah, no, I think that's absolutely a great place to start because, like you said, it's been a headline for quite some time now. And to your point, just some of the spending that we've seen recently, it's not surprising that we're going to need to see taxes probably increase just to give us an attempt at a balanced budget, right? But to your point, from a tax standpoint, I would say a couple things are currently being priced into the market from a tax perspective. First is on the personal side. I would tell you that the market is looking at really the probability, the highest probability event being one where we see personal tax rates go back to where they were in the Obama era. So back to 2016 tax rates. That shouldn't be maybe terribly surprising from an individual standpoint. I would tell you it's probably going to hurt to the extent that it helped the higher earners in 2017 through 2020. It's going to hurt them marginally with the changes that we're talking about. I would tell you that the market isn't terribly concerned about the prospect of marginally higher tax rates. Just as a reminder, if you look at kind of where those tax rates would be, that would be somewhere in the ballpark of 38, 39% at the highest level for your highest income earners on the marginal tax rate. Again, looking back to where we've been historically as a country, that's nowhere near the highest levels that we've seen, that we saw earlier in I would call it in the 20th century, when marginal tax rates pushed 60, 70%. So we're nowhere near at that from a tax rate perspective, but we are as high as they've been, or touching, back to as high as they've been, probably in the working lifetime of most folks that are, clients today of yours. So definitely something to understand. But again, from a market perspective, it's not terribly different than where we were 4 or 5 years ago. So the market on the margin doesn't view that as that much of a headwind. Similarly, on the corporate side of things, yes, you are going to see taxes go back probably again to where they were during the Obama era. I think what you expect to see there is corporate tax rates somewhere in the ballpark of 25, 26, 27%. Again, what really is happening is it's not as much a tax hike as it is tax cuts that are rolling off. So the way that one side of the aisle is kind of getting away with saying that it's not a tax hike, while the other side of the aisle is saying that taxes are going up. Both are true statements. But again, I would tell you the market is not terribly concerned and doesn't view it as much of a headwind on either corporate or personal side, with the idea that you're going back to the 2016, 2008 or 2008 through 2016, tax regime, if you will. Now, the biggest difference that's potentially in the cards, though, is the potential for treating capital gains and distributions as ordinary income. That, I think, is something that is not currently priced into the market. Markets, I think, would be, I would say, fairly pessimistic about that passing. You've obviously heard whispers about that. That's not something that's fully on the table as of today. But I would tell you with some of the work that we've done, some of the folks that we've talked to in DC and analysts that we've talked to that are tied in, that's absolutely something that's being discussed in back channels, and something that we think, again, if it makes it to the forefront, that could be a headwind from a market perspective. That's, again, it's not going to be catastrophic. We'll talk a little bit later about all of the positives that we see from a market standpoint, from an economy standpoint. I don't think it blows anything up on that front. But again, on the margin, it's a negative for this industry and for folks that are seeking to invest. It starts to disincentivize investing to some extent. If you think about, distributions and contributions being taxed maybe a little bit more aggressively. So all of that is important to understand. We're not quite there yet, but that's what we're watching for here at Horizon.
All right, and I want to pause on taxes for a moment there and talk about the possibility of capital gains receiving ordinary income treatment. Insurance policies have done so, say, from the dawn of time. So it is an interesting, we'll call it, advantage to the stock market versus the insurance business, which is, of course, an enormous business as well. So the annuity payouts have always been treated as ordinary income payouts. Now, I'm not suggesting that I'm a fan of taxing capital gains as ordinary income. I think that would be counterproductive for the work that we're doing. However, the point being is that it's something that's already that part of the tax law already exists for one piece of, if you will, investing public that are investing in insurance products. And that's not something we focus on here necessarily, but it is something that we can work with. So it's already something that we're dealing with from a taxable standpoint. The question is this: how would an increase of capital gains, in your opinion, be treated for the current capital gains? Meaning, we're at April of 2021. Would it be delayed? Would the implementation of that treatment of capital gains be delayed, or would it be something in your analysis or conversations at Horizon be something that would be enacted right now on all capital gains? Because if it were a right now on all capital gains, I think logically speaking, that would be poorly received. We've had a couple of really nice years here in the stock market.
Yeah. And again, I think the good news on this front is that this isn't something that's probably going to be in the cards for 2021. Again, I would say if that does come to fruition this year, that would be an additional surprise from a market perspective. But at this point, what we're looking at is more of a 2022, 2023 discussion for that being a possibility. I think what's probably being focused on as a 2021 change is that personal side of raising the marginal tax rate and the corporate side of raising those tax rates. So I don't think, and again, everything that we've seen and heard, it doesn't look like that capital gains conversation is something that gets baked into the 2021 tax bill. And then, as you mentioned, applies to folks that have pretty sizable capital gains given the run that we've had over the last last 12 months at this point.
All right, and to wrap it up, if you will, on taxes, the Trump era tax changes sunset in 2025. So I would think that the closer we get to that, the more palatable it'll be to clients and to investors to say, okay, there's a new higher tax rate and there's a change in how capital gains are treated. That'll be an interesting tax conversation to watch unfold, because again, while times are great and interest rates are really low, these bills will come due, and we'd like to be able to. I think I would like them to be paid off and not have I'll say my offspring and others bearing the burden of the full bill.
Yeah, at some point you do have to pay your bills, right?
You do, yes, even if you're the U.S. government. So let's hope they do that. So stimulus. Now we'll roll right into that. We've had some past conversations, and I like to bring them back because now we have the advantage of 2020 vision in that they've been enacted. Here they are. There's significant concern as you read through different investment firms, and of course, as much as I love Horizon Investments work that I get to be a part of, I also have others that I like working with as well and respect their opinion. There is a lot to be read about the stimulus packages and what it means to what looks like a very hot economy, for lack of a technical word to put in there, where we've got great economic activity. Joblessness is sinking, I'll say fast, and it looks like full employment could be a term that we're hearing more and more about come the fall of 2021. How does additional stimulus impact? We're not trying to find a negative and a positive, but how does it impact the positives that are already out there with more proposed coming at us?
Yeah, at this point, Lou, to your point, to some extent, it's kind of just gas on the fire, right? As you mentioned earlier, an additional $1.9 trillion on top of an economy that, as we've talked about a little bit, but we'll talk more about, an economy that's, probably by the time we get to late summer, early fall, we'll be back to some semblance of normalcy, is really only kind of adding an additional tailwind. Now, the catch there, right, and this is kind of what you're getting at, is does that cause an economy to start to overheat, right? And I think that's the risk, whether that's an inflation discussion, which I know we'll talk more about here in a little bit, or that's just talking about, supply-demand dynamics. I think you have a lot of that is, possibly on the cards, probably not in 2021, but as you get into 2022, you start to see that play out a little bit. But that's something that is absolutely a fair conversation. I think, what the government did from a stimulus perspective, what was done by the Federal Reserve as well, was really to try and provide a stopgap over an unprecedented time in terms of a global economic shutdown. And I would say to some extent, and again, we can kind of argue the nuances there, but to some extent, and if you look at the data around this recession that we are now out of, I would tell you, they did just that in terms of providing this bridge from entering a global pandemic to, once we get on the backside of this global pandemic, again, probably later this summer and early fall, if you think about kind of where we stand from a vaccine progress standpoint, and that herd immunity concept that's being talked about. Again, I think the stimulus money, if you think about what the government was trying to do, was they were trying to bridge the economy at a point when, again, if you think about where we were in April, May of last year, and the economy was running at 25 to 30% capacity, they infused capital into an economy to try and create that stopgap. And again, we can argue nuances about the effects of that, but what you see from a data standpoint is it did what they intended it to do. Now, the question is, what is the knockoff effects? What are the effects down the road? And I think that gets back into that tax conversation, that gets back into the inflation conversation. There are absolutely effects to that. But the other side of it would have been the consequences had they not done that. And that could have been catastrophic in terms of, just think about kind of Great Depression type economic activity, proceeding or progressing, and people being out of the workforce without any, additional monies or additional support from the government. That's probably a worse scenario that plays out over a much longer period in terms of an economic recovery. The question, and this is, what we're talking about, is the impact of the monies that were pushed into the system in the short term to prevent that from happening. What's the effect of that? And again, I think it becomes the inflation conversation eventually. We're just not there today. Now, I will say you're getting, and I know we're talking about inflation as part of today's conversation, you're going to start to see inflationary readings run hot. So as you mentioned, the economy that's starting to run hot. I mean, we saw the inflation number come out yesterday at 2.6%. Normally, the Fed, from an inflation standpoint, they're looking at how much are goods and services increasing in cost year over year. 2.6% may not sound like a lot. I would tell you though that normally that number that they're looking for is about 2%. So it is on the high end. And I would tell you as we get into April and May, it's probably going to be 4+% potentially. A lot of that has to do with the year over year comparison. It's what they call base effects, right? Think about where we started a year ago at this point and how low things were from an economic activity standpoint. So it's not surprising that you'll see that in April and May continue to increase. The risk, and this kind of goes to this part of the conversation, is, okay, so what happens in September or December or next February? are you still seeing, because of all the money that's in the system, or been pushed into the system, I should say, are you still seeing that inflationary activity? And that at this point is not fully understood and fully known. I would tell you that we're in the camp here at Horizon that we absolutely see an uptick in inflation in the near term, call it 6 to 9 months. But we do think that starts to dissipate as we get into 2022, because you do have this, what's called an output gap. So think of it as production, the ability of our country to produce. It's still, at I won't say at an all-time low, but there's this gap between what we're expected to produce and what we're actually producing. And we're just not, the gap between those two is at a historical high. So there's still this slack in the economy that we think allows for production to pick back up, which then allows for some of that money in the system to find places to go without creating hyperinflation. Think 1970s fuel lines, all that type of stuff. We're not in that yet. We think in the short term there's some risk.
I'm sorry, Austin. I'm just gonna, and apologies for adjusting the chair as well, but I want to get in close and really talk to you about inflation. And if you hear any background noise, it's because my window is open. It's a beautiful day here in Clinton, and usually you'll hear a horn or two. So apologies for that. But let's talk inflation a little more depth. I've spoken with a number of clients about inflation during conversations that I was having over the last month or so. And I really have a very, I'll say, simplified word or mashed up word that I've been using, which is, I'll give you a hint. It's B and S is how you can put it together. So because of this, and you and I have had a good conversation about it, I want to share that conversation with everyone right now, because anyone who's paid health insurance premiums knows that inflation has been a constant in healthcare costs. If you were to purchase a car 4 or 5 years ago, compared to today's costs, you know that you're paying a significant amount more to purchase. Pick any style vehicle that you'd like to. If it's the economy version or the luxury version, you're paying a lot more for that vehicle today than you were 5 years ago. And my personal favorite example is the grocery store. I mean, I go and I buy a handful of items. It seems as though I can't get out of the grocery store for under $100. And I go back and put everything in my refrigerator and wonder, wait, what did I just get for that $100? And that's, I'm being serious about that. So I think there have been pieces of inflation that have been, if you will, going on right under our nose, figuratively and literally, that we just live with. So I'd like for you to explain the pieces of inflation that are now making up that 2.6%. Not every single one of them, but give us the overall pieces that make up that 2.6% that you're talking about, and what you ultimately see as an inflation number. And just one comment that I want to make on everything that you mentioned as well. When you talk about inflation, you're talking a rolling 12 months, right? So May to May is really what we're looking at as the inflation number. It's not a predicted number. It is what did it look like April 14th of 2020 versus April 14th of 2021, 2.6% higher at this point. Is that correct?
You're absolutely correct.
Okay.
So I would tell you, if you're looking at kind of the components of those inflation statistics, think of it as just what inflation tries to measure from a government reading perspective. What they're trying to get a sense of is there's a basket of what they call goods and services that includes a number of different things, right? It includes food, beverage, so your groceries, right? It includes your housing costs. It includes, clothing and kind of what they call apparel, right? It includes your transportation costs. It includes, as you mentioned, medical care. It includes energy. So think about, if you're putting gas in a car or you're paying to heat a house. It includes kind of the last couple components are there's an educational component in there, which we all know kind of the cost of education. So that contributes to it. And then there's kind of the last component is going to be what they call kind of recreation and other goods and services. So about, your concert or your sports activities, or, the day-to-day, maybe have, things that you're doing that, you're paying to go do leisurely. So all of those components are then balanced over time. And if they're looking at that basket, obviously each of those has a weighting in the basket. So Lou, to your point about healthcare, for example, right? That makes up, I think it's like 6 or 7%, maybe a little bit higher now, in terms of kind of the overall component of that basket. Your food costs make up, I would say, the biggest component of that basket. But there are different, because what you're trying to get a sense of is there are some segments of the economy where you're seeing more inflation. There are other segments of the economy where you're seeing, in some cases, disinflation. We talk about energy prices and gas costs today versus where they were maybe 10 years ago at this point. And we all know that, gas at one point was $4 a gallon, and today it's $2.60 or 70 cents, right? So you can make those cases that certain areas go up and down, but overall they're trying to get a sense of what's the aggregate of that basket of goods. Now, what is, I would say, probably more interesting for the individuals, Lou, that you're working with is they may not buy the basket as it's constructed, right? They may have a higher cost of medical care, right? So somebody that's retiring is probably going to have a much higher proportion of their spending be in medical care. So their personal inflation rate may be much higher than 2.6%, because the component that is bigger for their spending is a component that is, up 5, 6, 7% every year for the last 10 years. So those are different ways to think about it. I would just say the overall measure that the government's looking at is this idea of a basket that they're weighting proportionally based on kind of what they see is on average across the country and across the demographic spectrum.
Well, and I could just hear a number of people cringe as you said, healthcare up 5, 6, 7%. I would welcome a 5, 6, 7% increase in my healthcare costs. And by my healthcare costs, I mean premiums on health insurance each year. They're 10, 15% regularly, and it's a frustrating thing to watch. As fortunately, I have a healthy family, but it is an interesting discussion as, again, it applies to bringing it back to the taxes and what the changes could be, fitting all of those pieces together. So before we get into the auto industry recap and with, let's say, 20 minutes or so before we wrap up, let's talk market. I promised everyone we would talk the markets, and it has been quite an interesting ride. The last 12 months now does not include March of 2020. So if you only look at the last 12 months, you're looking at some extraordinary numbers as it applies to investing. And what sectors have we moved from our very first conversation, Austin? I remember them all, okay, because mind like a steel trap, and I guess the memory of an elephant, right? Is they supposedly have a great memory.
There you go.
So our first conversation ever was a discussion of the stock market and the FANGs, the 5 and ultimately what became the FANG, the 6 that were driving the markets forward. Have we moved into a more broad-based market increase? Why have we, in your opinion, moved into a more broad-based market increase? And what's propelling it? And then what could slow it down, in your opinion?
Yeah, no, I think that's a great segue. Because Lou, I think what you've seen over the last 12 months at this point has absolutely been kind of what we would call a transition of leadership, right? So coming really through the pandemic, kind of the bottom there last March, and then coming out of it, really for the first, let's call it 4 or 5 months post-March, when you had that kind of sharp bounce from a market perspective, you absolutely had leadership from kind of those growth and technology stocks that you're talking about. So your Facebooks, your Apples, your Amazons, your Microsofts, Googles, right? All of those stocks were leaders in the space. One, because they weathered the global shutdown the best, right? Technology companies have an inherent advantage that they don't need to be person to person, face to face with their clients. So that obviously helps you when you can't leave your house. But also from a growth prospect standpoint, even coming into the pandemic, those were some of the companies that had the best growth prospects. And growth was, I would say, somewhat scarce really across the marketplace. So you had a segment of the really of the market that had those growth prospects. And then I would tell you really pre-pandemic growth prospects market wide were, let's say, somewhat muted, a couple percent maybe at best. Whereas some of those tech names that we talked about, they're growing, we're growing, and to that matter, continue to grow at a higher clip. So that's why you saw leadership, coming into and then through the pandemic from some of those names. What you've seen more recently, I would say over the last, at this point, 6 or so months, has been this transition and a transition to more, think of it as kind of traditional, your Dow Jones industrial type names, right? Companies that actually make goods. Maybe it's an industrial type company or a material company where they're making physical goods rather than providing services. And you've seen leadership in that segment of the marketplace for a couple of different reasons. One, as we talked about, those were the companies that were forced, or I guess did experience some of the brunt of the pandemic, because when you're not meeting face to face, you don't sell as many, goods. Just kind of that's how commerce works to some extent. But what you're also seeing is, given the stimulus money, given the money that's in people's pockets, the outlook for many of these companies going forward is actually growth that they haven't seen in years. And that's really important to think about. Where we talk about growth being scarce pre-pandemic, and for that matter, coming out, first 3-4 months coming out of the bottom, I would tell you growth today is not really scarce at all. If you look economy wide, and some folks may have seen this, there are expectations that the U.S. economy could grow 6, 7, 8% this year, which is numbers that normally you expect to see out of emerging economies, right? You expect to see that out of China or companies in the that are in, let's call it Eastern Europe, or for that matter, Africa, right? Countries where the year over year numbers are growing so fast because their population's expanding, or because you're getting technology to areas of the world that maybe haven't had certain technologies. You don't expect large developed companies to grow at that pace. Again, U.S. growth rates are normally somewhere in the ballpark of 2, maybe 3%. We're going to see double that, if not triple that, potentially this year. So going back to that scarcity of growth conversation, if the economy as a whole is growing that fast, growth isn't scarce at all. You don't have to pay up, if you will, for growth. You don't have to pay up for those technology kind of high-flying company names. All of a sudden, everybody's growing. So let's pick companies where you've got really strong fundamentals, you've got really strong balance sheets, and you've got this tailwind of coming out of the pandemic, where folks are again, money in their pocket, that they're going to be spending on some of those materials and certain, goods that maybe they weren't buying, 6, 9, 12 months ago at this point. So you've absolutely seen a transition on that front. I would also tell you, you've seen a transition in terms of market leadership, in terms of smaller companies. So we talked last year about how larger companies were able to withstand the pandemic much better than smaller companies, whether it was due to technology or infrastructure, or a number of different reasons. Well, flip that on its head in 2021. Again, you're starting to see us come out of this pandemic. Small companies on the margin are growing faster and expanding quicker than your larger companies. And as one of our portfolio managers says here internally, markets don't move based upon what happens to an individual company or a set of companies. Absolutely. Markets move based on what happens on the margin. And what I mean by that is, yes, Amazon, Facebook, Apple, Netflix, Google, those FANG companies, are still great companies, still have great outlooks. But the margin or the rate of change between their growth numbers, maybe they were growing 6% and now they're growing 8%, is very different than a company that was growing 1% and now it's growing 6%. The marginal change obviously is very different, and that's what the market rewards. And that's where you're seeing, again, this change of leadership over the last 6 months into some of those types of companies that are really seeing this pickup as we are on the backside at this point of this global pandemic.
All right. So change in those companies, and by leadership you mean stock leadership of the markets, to bringing in the smaller companies. I have to make sure that I say that Tranquilli Financial Advisor came through the pandemic wonderfully, and it's because of all the awesome people that are part of this call and the others that will watch it later on. And I'm being serious about that. The technology was already here, Austin, and it is interesting to watch other companies, other advisors that I'm friends with, try to catch up to the fact that we've been on Zoom for 3 years with clients because fortunately we have people that we work with all over the country, and this was necessary. It is interesting to watch other companies, larger companies, smaller companies, catch up to this technology. And I'm curious, and this is I'll say just off the cuff question for you. What do you see from those companies as they catch up? Is that something that it seems so obvious to me that it would drive the economy forward because they have to go out and buy these technologies? They also have to go out and maybe change the equipment that they're working on. There's a lot of talk about bringing manufacturing back to the United States. And I've had a conversation with almost every client that I work with that I've worked with my 2 older brothers after school. They're welders. And for years and years, they've said it's difficult to find manufacturers, and they are manufacturers. And I'll be darned if we'll call it 30 years later, they aren't right on the money that the U.S. wants to bring back manufacturing, which I think is a wonderful idea to some extent, of course. So isn't that something that we could look forward to and say that's a positive of the U.S. economy, that instead of all this technology being the leader, welders are the leaders again? Am I reading too much into that?
No, I think that's a perfect example. I think what you're seeing is segments of the market, of the economy that have been beaten down to some extent. And I say beaten down, they've just grown slower on the margin than some of your high flyer names that we've all seen and talked about in the headlines for the last, call it 5 years. You're seeing this normalization really play out over a shorter time period. And will probably continue to play out, to your point, as we head into the remainder of 21 and possibly often also into 2022. I think you're seeing the dynamic of the economy just change ever so slightly, like you said, because certain companies are being forced to, and again, maybe it's more smaller companies, but I would say to some extent it's just broadly, companies that are being forced to change because of what has happened over the last 12 months. Maybe they could have gotten away with their, the way that they were doing business up until the global pandemic. And at that point, it proved very clear that they had to change or get left behind in this new economy coming out of this. And that's the other thing I would say around kind of this, around this recession and this pandemic is, and you see it with every recession that we go through as an economy, is the way that the economy enters the recession is going to look different than how the economy comes out of the recession. And we see it today. We saw it coming out of 08, and that's not good or bad. That's how it works. You don't expect it to go back to the exact same as how it was. And Lou, I think that's what you're getting at is there is absolutely going to be a change. The economy is not going to look exactly the same as it was in February of 2020 once we're on the backside of this in the latter half of 2021.
Well, and Austin, that is what I'm getting at in that it's a change, it's a growth. Some things fall away, other things move to the forefront. I'm really a big fan of saying this. If you're not on the wave of change, you're crushed by it. So I have no intention of being crushed. So let's ride, kind of thing. And switching over to a previous discussion that we had about the auto industry, which was a great discussion about what it could look like from a sales standpoint, because the numbers were so depressed in 2020. Well, now we're reading about chip manufacturing being a genuine issue, and Ford and GM slowing down production of their vehicles because of the fact they can't get their hands on the chips that now go into, I would have to say, every vehicle. I don't know that there's a vehicle built that doesn't have some kind of computer technology in it at this point. Someone is welcome to correct me on that if they're I think the only vehicles that are out there right now that don't have a computer chip in them are called bicycles, and that's even questionable. So the auto industry, what does this mean for it? Are there places where the auto industry won't slow down because the chips are available to them? Just commentary on that, if you would.
Yeah, no, and I think it's even a broader discussion. I mean, when we talked about it earlier, unfortunately, it's probably not just the auto industry. It's just this is the first one that we're going to see when it comes to this chip shortage. But you're absolutely right in terms of the slowdown and maybe some of the stress that's going to put on that segment of the economy. I would tell you what you're probably going to see, and this goes back to our earlier conversation. You're going to see some inflation there from a pricing standpoint because of the supply-demand dynamics. The lack of supply, given the chip shortage that we're talking about. And when we say chips, what we're talking about is semiconductors specifically. And there's a number of different manufacturers of those. Most of those are either in Asia. Some of those are now being manufactured in the US. But I would tell you that you've seen that shortage really start to kind of bubble up, call it maybe 3, 4, or 5 months ago. So you started to hear rumblings of the possibility of that being an issue. And what you see today is really that coming to the forefront, which again is going to affect autos first and foremost in terms of what we're seeing. But it's also going to affect a number of different other technologies, Lou, to your point. Whereas maybe, 10, 20, 30 years ago, you could make cars with very little technology to some extent. Today, that's just not the case. The computers that are being built into the cars today are probably greater than by an exponent of what's sitting on all of our desktops. It's pretty crazy to think about how much technology actually is in any one car that is on the road today. So new cars, I think you're absolutely going to see some price appreciation, some inflation there. Again, going back to that conversation, that's a component of that basket of goods that we're talking about or we're looking at. But I think it does bleed into other segments of goods and services that we're looking at. Eventually, it's just the first one that we're going to see is on the auto side.
Well, this is completely bragging, so live with me for a moment about it. I used to be able to flip the hood of my car open, and I could change the spark plugs. I could go to the alternator and know what I was looking at. The linkage for a stick shift, if I had to tighten the 9/16 bolt that was on the linkage, no problem at all. I don't even pull the lever on the hood of my car at this point because what's under there is somebody else's business at this point. It open it up and literally, for certain manufacturers, it is a computer. There's nothing even under there at this point. So it's again that wave of change. With a few minutes to go, I want to talk about the initial public offerings, IPOs. We won't get into SPACs, the specialty purchase.
Special purpose acquisition corporations. Yep. Yes.
Okay. Thank you. I joked about them being the new spam, but not the kind that you buy in the store. But so we won't get into those today. And maybe next time we'll do an update on SPACs and Bitcoin or cryptocurrency. But IPOs, there's a lot written about initial public offerings. 2020. We witnessed the largest number of initial public offerings of the last 20 years. Now, as I talked to you about it before, for our prep call for today, that would seem like a good thing. There are more stocks available. Economy is great. People and companies have money to go out and build their company because they've now gone public. So they receive this windfall of stock purchases. However, on the other side of that, there's a lot written about the warning signs. And again, I'm not trying to find the bad in a good situation. I think part of my work for clients is to be skeptical, and I find skepticism, and I look at that information and really the history of it. You can't ignore it, or you're bound to repeat it. IPOs are a bit of a red flag for the markets. You are the analyst on the conversation. I want to hear what you have to say about that.
No, I think it's absolutely worth diving into because, again, if you look at the data, right, the last time that we saw IPO activity where we see it today was the late 90s, right, which we all are familiar with, kind of what we saw in 98, 99 with the tech bubble. So that's really where that came from. And as you see the data come out today, there are definitely some similarities between kind of 98, 99, which can be a pause for, or I say a cause for concern, or a cause to at least pause and look at the data. I would tell you the good news is that in 98, 99, when you were seeing that level of IPO activity, the difference there is that the value of these companies was really swamping the marketplace. And what you then saw was with some of the failures in the IPO market, that it was having an effect on the market as a whole, because those companies made up such a large component of the market broadly. The good news as we get into 2020, 2021 around the IPO conversation is, yes, you do see IPO activity in terms of companies that are going public, right? They're having that public offering. The good news is that they are not really anywhere near as large of a component of the marketplace. So you've seen a bunch of companies, go public. I think there's only one or two of them that have even made it into the S&P 500. Obviously, Tesla being, one more recently that we've seen, kind of catapult into the top of the marketplace. Outside of that, though, it's honestly a lot of the same names that we've seen over the last 5-10 years. So that's the good news, is right. You're seeing this activity, but it's not bleeding into the market as a whole. And what you've actually seen is over the last month or two now is you've seen a number of those companies that have had their initial public offering, seen this kind of return to earth to some extent. And I would tell you, for folks that were buying those IPOs, that can be, within a portfolio that can be very volatile, that can be very troublesome, that has probably erased a certain level of wealth in that scenario for those companies specifically. But again, the good news is it hasn't bled over into the S&P 500. It hasn't bled over into your larger allocation portfolios, because those IPOs, even though there has been a lot of activity, they don't make up nearly as much of the marketplace as they did 20 years ago. Now, what I would say is, if that trend continues in terms of kind of this coming back to earth in terms of the IPO market, it does probably start to stifle, I would say, entrepreneurial activity to some extent going forward. And that can be concerning down the road. I don't see that happening. I don't think we see that happening anytime soon, just because of the tailwinds that we see to the economy right now. We think that typically comes hand in hand as you start to see economic slowdowns, which again is probably pushed a couple years down the road at this point. But it's something that obviously bears monitoring in terms of that IPO activity, and then obviously the subsequent price action that you see with some of those stocks.
Okay, and I final comment on that, and then we'll wrap it up right here. But so drove out to the University of Pittsburgh and then Ohio State University and Chicago just for a visit over the weekend to Chicago with two of my sons, and we had great conversations along the way. And I read about this consistently and what Horizon produces, and of course what other investment firms produce. So in having the conversation with one of the conversations and talking a little bit about my work with them, I talked about Instagram with them. And they said something to me that I thought was really interesting, and I will dig into more. They talked about how people they know actually get work off of Instagram. Artists, creative people are on Instagram, and people are finding them there to work with them. Now, I don't want to give an advertisement to Instagram because I don't look at Instagram, and I hate to date myself that way, but I don't look at Instagram. So, but it was a curious comment that I'd like to find out more. How much commerce is actually happening on those companies that are IPOs that I could really question whether they have real value as a company. They're not producing anything whatsoever, but the communication part of it becomes an interesting conversation to have, and we'll do more of that down the road. Austin, we're at 50 minutes. Well done as always. If there's any final piece that we didn't get to, I'll welcome you to comment on it right now.
I mean, I think the overarching view from our perspective is that things from an economic standpoint look obviously light years better than they did 12 months ago. I think to what we talked about, there are things to monitor and keep an eye on as we move into the latter half of this year from a risk perspective. But in the short term, we do think that the tailwinds are extremely strong. And we, here at Horizon, are obviously trying to take advantage of opportunities where we see them. And we've had a good start to the year, but the goal is to continue that as we see opportunities for really the remainder of the year. So,
outstanding. And I want to thank everyone that's here listening live, and then of course everyone that receives this as part of the email that I'll send out to all clients with the recording of this conversation. Please share it with friends. We are absolutely looking to grow at Tranquilli Financial Advisor, and certainly working with Horizon as a partner is appreciated, respected. And for everyone, thank you again for being part of the conversation. There'll be another coming up soon. Look for all of those emails that are coming, including an announcement of our communications intern, Lena Akram, who's joining us as I speak. So I'll announce that as well, and I'll talk with everyone soon. Thanks, Austin.
Thanks, Lou.